Hi, I'm Joe Vidueira with Eagle Harbor Advisors. I'm here with Andy Wilkins, and we're going to talk about the several types of risk that investors need to consider when putting together a comprehensive financial plan. Andy, obviously the word risk is a loaded one if there ever was one. It affects clients of all ages and stages of life. You're a certified financial planner, so you're well qualified to talk to us about risk. Why don't you start by telling us about the major types of risks and what our listeners need to know?
Certainly. And Joe, thank you so much for the opportunity to have this conversation with you. The financial industry is this very odd habit of complicating simple things and simplifying complicated things. Joe, when it comes to risk, our responsibility to clients is to focus on the numerous types of risk. There are actually dozens of different types of risk. Market risk, liquidity risk, concentration risk, credit risk, reinvestment risk, inflation risk, horizon risk, longevity risk, foreign investment risk, currency risk, interest rate risk, business risk, probably another dozen types of risk that can happen inside of a portfolio depending on the types of solutions, securities, and investments you choose.
Okay, great. So let's zero in on a few different types of risk that we can cover today to explain to our listeners which ones they really need to focus in on. Where would you start?
Probably the most obvious. So you say risk to a client. I would venture to say 99 out of 100 times they're going to think of the major risk, market risk. The volatility of the principal you put into an investment. I put in $100 to a stock, its value going up, and then the risk that people feel the value going down in that investment, whether it be $100, $1,000, $1 million. Market risk is going to be part of a portfolio. There's almost no way to avoid that. For a long-term balanced portfolio, there is going to be some elements of market risk inside of it. Again, it's not the only type of risk we worry about, but it is one that, of course, is a concern to clients. They get very nervous. Is my money going to be less? Will I have less money over a period of time? And of course, it's something that we want to be able to help address for clients.
Right.
Now, understand that market risk, we used this example in a previous discussion, but I think it's still apt here. Market risk, how do you combat against it? And it really is time in the market, not timing the market. If you look through the history of the markets, we're talking about 150 years worth of data, you will see a pretty clear signal that the longer you are in the market, the better you're going to do. The S&P 500, I always like to call the reverse casino. A casino wants you to sit in your chair for as long as they can, because statistically, you're going to keep giving them more money.
Right.
The flip side is true when it comes to the S&P 500. Through multiple means of analysis and statistics, they've gone back and seen that any 10-year period in the history of the market, you will have a 94% chance of having more money after 10 years. When it comes to playing the odds, that's the type of casino I'm going to go to, where I have a 94% chance of being able to make more money. The other points that needs to be made with this is finding the appropriate level of market risk. And this all gets back then to conversations we've had as well in regards to allocation and diversification in a portfolio. Investors need to assess when they need access to capital and when they need access to income from portfolios. So that's all gets back to being able to control the level of market risk that you take.
Would you say concentration risk is a big part of market risk?
Well, they parallel each other. Cliches are sprouts of seeds of truth. And one of the most popular cliches, which is completely covered in truth, is that don't put all your eggs in one basket. Even if you love certain types of investments or a sector of an investment, let's just say tech stocks, you still need to have a portfolio that does not become over-dependent or overly concentrated in any one of those areas. There absolutely are periods of time where even the best of companies in certain sectors are just going to decline in value. And the danger of concentration means that while you have those big ups as can happen, the declines can be just as steep for somebody.
So diversification is obviously key. What if, though, an investor has a particular expertise in real estate, for example, knows a lot about it and has done well in that field, why shouldn't he focus most of his assets in that one area?
Well, let's be clear. Real estate's a great investment. And real estate is a wonderful part of a portfolio that a client could own. At the end of the day, real estate does boil down to two things, three possibly for certain real estate investors. It's about appreciation and income. Other folks can use it for very specific tax purposes, but let's stay on a higher level with that and say appreciation and income. Real estate, just like anything else, properties can appreciate, but then also they can stagnate and depreciate over time. We've seen that numerous times in the history of real estate, just like with the stock market. Income as well. Income from properties, rental properties. Well, it's only as good as long as you have tenants inside your properties when it comes to either commercial properties or residential, multifamily homes, single family homes, apartment buildings. You still need people in there to be able to do it. People move away from a certain area, a certain type of property becomes less desirable. Suddenly you don't have that income or the consistency of that income as much. So for folks that have real estate holdings, we are absolutely pro real estate, but always as part of an overall diversified portfolio because they can have their risks as well inside of real estate. So folks highly concentrated in that area, they may lose some of their liquidity, they may lose some of their diversification. That's all dangers that they need to be aware of.
Right. So what would you say is an acceptable level of liquidity for the average investor?
Again, these are questions that always can be individually based. A general rule of thumb, a net worth of $1 million, you would like to see at least half that be available in liquid assets that folks have access to. Those assets can become income producing, appreciation producing as well for them. But when you are dealing with what we would call that kind of standard household, $1 million, $2 million net worth, you do want to have at least 50% availability for your assets. When you start talking about clients that we have that net worths are reaching 10, 15, 20 million, we're talking a little bit different strategy here. Yeah, the liquidity needs, could be a smaller percentage, and it's going to differ for people. But as a general rule, you want to be very careful as to not have any overconcentration in any area, illiquid real estate being one of those.
So what would you say is an acceptable level of risk?
To really put an emphasis on liquidity, because I think there's really important points there. Liquidity means I can turn that into cash, monies that I can use to spend and go use at the grocery store within 30 days. That's the investment world definition of liquidity. Most people would define liquidity as, is it in the bank right now? That's a conservative but still very prudent definition of liquidity. When it comes to liquidity, the financial planning rule of thumb is having 3 to 6 months of investment expenses available at all times in an easily accessible account, usually a bank account. But liquidity also needs to be mindful that what of my assets can I turn in and sell easily? Doesn't mean you're not going to lose money on it. Maybe it's made money. That's not the question. A house is not something that you can just decide to sell and have ready to go for you in 3 days. There's a whole process that has to go through with the sale of property or home. A car is very similar to that as well. Knowing what of my assets can I turn into cash if I ever need to do so is liquidity. And liquidity risk, if you have too much of your assets concentrated in one area or even diversified to many properties, but still properties nonetheless, or tied up in certain types of investments that have surrender schedules. Example, you don't want too much money into annuities, which are great solutions for clients, but you're not looking to put 60, 70% of your monies into annuities if you have a net worth around 1 or 2 million.
Right.
So liquidity risk, to really put a pin on that, is something that is a great concern to people if you're not properly planning.
All right. So we've discussed market concentration and liquidity risk. Is there another critical risk that clients need to be especially aware of?
I think in today's world, with healthcare constantly improving, with people living longer, the one that is becoming more and more of a concern to me on the financial planner side of the investment world is that of longevity risk. Gone are the days where we see people being called, oh, they made it to 75, they died of old age. In today's world, 75 is still young and spry. We're seeing people still out playing pickleball, running on the beach, well into their 80s, 90 years old. People are living longer than they ever have in the history of the world. Therefore, they need their assets to be able to last for them throughout the entire length of their life. So longevity risk is one that we have a lot of concern with. How do you make sure that you're not outliving your money? 30, 40 years ago, retirement was generally speaking a 15 to 20 year endeavor. We've entered a world now where retirement is lasting 30, possibly 40 years for people. And as baby boomers are going to continue to retire over the next several years, the health care that they are receiving continues to get better and better. And people are, generally speaking, people are getting healthier. And we need to have that plan in place for people to ensure that the assets that they've accumulated and saved enters with them into the next phase of their life. In this case, the phase of their life where their work is reduced or eliminated, retirement years, but moving into a new phase that they know my assets then can last for me forever.
Right. Okay, very good. So there's another kind of risk that we haven't touched on yet, but which obviously connected to all of these and is clearly important, and that's inflation risk. Mm-hmm. Can you tell us a little bit about that?
Well, absolutely the topic du jour of today being inflation risk, where since the COVID situation beginning in 2020, and even with seeds planted earlier, inflation has been something we've not really seen in recent times coming back again. But like a lot of other things, it ebbs and flows. Market risk can ebb and flow. Inflation risk is now ebbing. We've seen inflation levels that we have not seen in 40 years rearing their ugly head again. What is inflation? Very simply, the power of my dollar is less than what it was previously. I used to be able to buy 2 sodas for $1. Now those 2 sodas cost $1.50. My dollar is less. I need more money to get the same amount of goods or services that I was once able to purchase previously. It's a natural part of the economic cycle that inflation does grow over time. But with these big spikes that you may see, it can put a huge burden on people in their spending needs. And like many of these risks, they connect. So we see the connection between longevity risk and inflation risk. Goodness, if we're living longer and prices are going up at the same time, what are we to do? It all gets back to the things that we've discussed in other editions of our conversation, things like the controllables about how we allocate our monies. A portfolio, if we look at those pie charts, is designed a very certain way for people. You have assets that are designed to grow over time with you to beat inflation. The 3 big ones historically have been equities, stock ownership, real estate, and commodities. Those 3 asset classes have typically performed the best during inflationary periods. We're seeing many of those things occur even recently during inflationary periods. Prices have gone up, but around the country in between 2020 and 2023, real estate prices also grew pretty substantially around the country. Equity markets have grown over that period of time. Commodities have grown over that period of time, and they've slightly outpaced that inflation. That's the key. You need to have some parts of your portfolio always, even as you get older and you feel you need to be more conservative in your allocation, conservative meaning a reduction of volatility. There always needs to be a place for that growth potential. But it ties back in inflation to longevity. Also, part of the portfolio needs to be consistent for you, to remain for you. We've had other video series with annuities that provide lifetime income streams for clients. So it's all this question of what is that proper balance for me and what are the needs and wants that I have in life? How do we provide for those needs and wants while knowing that there's other risks like inflation, like the market risks, and avoiding the things that we can, like over concentrating in certain areas. With all that different types of risk, many of them are interrelated. The best way to mitigate those risks is to diversify out your assets, understanding the level of risk you're taking and how they all balance together, and making sure that your costs are all in line to meet those needs over the long haul.
Right. Those are great points, Andy. So if our viewers would like to get a hold of you to further discuss these risks or how they can mitigate them in their portfolios, how can they contact you?
Well, on our screen now is our contact information for eagleharboradvisors.com. My email is available there as well. we want to have that conversation with you. Risk is a natural part of life, but one that we feel very strongly and confidently with. We can provide a greater level of security in that investment world, in that financial planning, in that wealth management for you by understanding what your specific risks are, needs are, wants are, and formulating that plan for you.